We reviewed how to account for the sale of merchandise inventory in our previous video, and now it's time to learn how to account for the cost of that inventory. The person responsible for paying for the shipping costs of those goods depends if you do FOB shipping point or FOB destination. In our previous video on merchandise inventory, we defined these. FOB shipping point means that the buyer is responsible for the goods while they're in transit, and then FOB destination means that the seller is going to be responsible for the goods while they're in transit. So a consignor owns goods that they will have someone else sell on their behalf. Since they own the goods, they will account for it on their inventory until it is sold. The party who is selling on behalf of the consignor is the consignee. They will be paid a commission to be selling on the consignor's behalf, but they will not be reporting the inventory on their books. Some goods will deteriorate over time, become obsolete, or be damaged, but if they can still be sold at a lower price, then they will be sold at their net realizable value. This is found by taking your estimated selling price minus any cost you incurred to sell that inventory. If you have ever worked for a business that sells merchandise, like personally I have, then you will understand the pain of taking inventory. The physical count can be dreadful, but it's necessary to make sure that what you're accounting for is actually there. If something were to happen to that inventory, then we have to make an adjusting entry to reflect what is actually there. When a business buys the same goods at different costs, we have to figure out which cost of goods we will be accounting for. There are several ways for a business to account for the cost of inventory. That is FIFO, LIFO, specific identification, and weighted average. Our first method, FIFO, first in, first out, will record costs in the order they were incurred. If my boutique orders 3 units of accessories on different dates, I will exhaust that first package I bought before I touch any of my other inventory and record the cost of goods sold for those accessories. To simplify it, imagine your box is full of lipstick. I will open that box and I will sell every lipstick from that box first before I open another box and sell from there. The reason a business accounts this way is because your prices for your goods will not always be the same. Depending on the economy, your prices are going to fluctuate and therefore so will your cost of goods sold. If I buy 100 lipsticks at $15 each, my inventory equals $1,500 at the beginning of my accounting period. Now let's say 5 days later, I bought another 80 lipsticks at $18 each. My total inventory will be $2,940. Now let's say the next day I sell 75 lipsticks. I will take 75 lipsticks out of that first package of inventory, and since each lipstick cost me $15 from that package, I will multiply the number of lipsticks sold by their cost. $1,125 is my cost of goods sold. My inventory now shows 25 lipsticks at $15 each and my 80 lipsticks at $18 each. Now the following day I sell 47 lipsticks. I will exhaust the 25 lipsticks from that first inventory package and then will dip into my second inventory package to sell the remaining 22 lipsticks. Now my inventory will reflect 0 lipsticks at $15 each and 58 lipsticks at $18 each. As the prices for goods rise, FIFO will yield a lower cost of goods sold and therefore a higher net income. Let's move on to our second way of accounting for inventory, LIFO, last in and first out. Go back to our packages of lipsticks. My second package of 80 lipsticks at $18 each that I bought most recently will be my first of my inventory supply that I exhaust, and I will use the cost of those goods first. If I sell 95 lipsticks, I will dip into my inventory of 80 lipsticks at $18 each and drain that package before I sell the last 15 lipsticks out of my first inventory package of 100 lipsticks at $15 each. When costs are rising, LIFO will yield the lower income, but as costs decline, LIFO is going to turn a higher profit in comparison to FIFO. A lot of businesses like to use LIFO for its tax advantage. A lower income means a lower income tax. But the IRS mandates that if you use LIFO for your tax reporting, you have to use it for your financial reporting as well. This follows the LIFO conformity rule. Since our costs for inventory can be different, instead of using FIFO or LIFO, some businesses will account for their cost of goods sold using a weighted average system. So my first package of 100 lipsticks at $15 each and my second package of 80 lipsticks at $18 each will give me 180 lipsticks at 16.5 each. I found the cost for this lipstick by adding the cost from both lipstick inventories and dividing it by 2. Now, if I sell 40 lipsticks, I will take 40 lipsticks out of my available merchandise and record that cost as 40 lipsticks at $16.50. Using the weighted average system is going to level out any drastic fluctuations in cost for that inventory. Our last method will be specific identification, where the assigned cost to that inventory is matched with a specific invoice. If I have 3 boxes of inventory, my first of 100 lipsticks at $15 each, my second of 80 lipsticks at $18 each, and my last package of 45 lipsticks at $13 each, I will record cost of sales according to which lipstick inventory I sold from. If I sold 42 lipsticks out of my unit that cost me $15 each, I will record cost of goods sold as 42 lipsticks at $15 and take value away from my remaining inventory for that unit. But if I sold 76 lipsticks of the unit that cost me $18 each, I will record the cost of goods sold using those respective numbers. After you apply one of the 4 costing methods, you are going to want to record inventory at the lower of cost or net realizable value. Whatever you paid for it and then whatever you can sell it for, you want to choose the lower number, that way you do not overstate your assets. So if I bought high heels for $60, but my net realizable value is $50, my inventory will be reported as $50. I am choosing the lower number. This is required by accounting because you do not want to be valuing your assets at more than what they are worth. If I take a physical count of my inventory and find that it's understated, my cost of goods sold will be overstated and my net income will be understated. If my inventory was overstated, then the reverse happens. My cost of goods sold will be understated and my net income will be overstated. Neither of these are a good situation, but unfortunately, mistakes in inventory happen. We always end our videos with some sort of ratio, and today we are going to be computing for the inventory turnover. This is going to show how many times will my business sell inventory in the accounting period. It is going to be a good reflection on whether or not the company is managing inventory well. A low ratio is a sign that the business is not selling enough inventory, but a high ratio might mean that the business is at risk of not having enough inventory to keep up with the sales. It is probably better to have a higher ratio because this means good sales, so long as you have enough inventory to keep up with the demand. So take your cost of goods sold and divide it by your average inventory to find this ratio. Our second ratio is the days sale in inventory. It will show how many days a business can sell its existing inventory without making any new purchases. To find this ratio, divide 365 by your inventory turnover. Honestly, this lesson can be challenging, but it gets a lot easier with practice, so go down below, check out my free downloadable study guide and free practice worksheet, and don't forget to subscribe for more lessons on accounting.